this time of year, we like to take stock of the European construction market to get a clearer view of how it's doing, which countries are seeing the most success, and which are not doing as well.
There are many different issues affecting the progress of various European economies at the moment, and as always, there are some marked differences between them. There are many reasons for optimism across Europe, but at the same time, the construction industry is not all good news.
Any market outlook at the moment is going to include a certain amount of guesswork, with political instability in some quarters and the UK's decision to leave the European Union among the uncertainties facing all industries across the continent. However, when looking at the state of an industry, it's always worth taking the GDP, the gross domestic product, into consideration. And the good news is that data from the European Commission has indicated an increase in EU GDP of 1.9% for 2015. And this is expected to remain level in 2016, with an increase of 2% predicted for 2017. It was the first year since the start of the financial crisis that all member states reported an increase in output. While these are not necessarily huge rises, it has to be admitted, it is good that the trend is continuing. Europe will have to wait and see whether the decision in the UK to withdraw from the EU will have an effect beyond the shores of that country. However, it seems clear that an intention to leave and the uncertainty around it is going to be a problem within the UK economy, in the short term at least, but maybe for some time to come.
According to a new report by specialist consultancy FIEC Research, which like Construction Europe is part of the KHL Group, the decision to leave the EU will steepen the downturn in the UK's construction equipment market and could have a significant inflationary effect. The report, The Impact of Brexit on the UK Construction Equipment Industry, includes a 5-year forecast for sales of construction equipment in the UK, which has been developed following a series of in-depth industry interviews following the unexpected referendum results. Sales of construction equipment in the UK are expected to be 10% lower this year than in 2015, compared to the previous pre-Brexit forecast of an 8% decline. The trend of lower than previously expected sales is expected to endure for at least 3 years.
Whatever the direct or knock-on effects that the Brexit decision will bring with it, the EU can point to a moderate recovery. FIEC, the European Construction Industry Federation, said that the EU economy was still facing heightened risks. It suggested the recovery in the EU was supported, for the most part, by several positive factors such as low oil prices, the euro exchange rate, and the very low interest rate levels. These have stimulated exports and private consumption. However, it also pointed out that the level of investment remained hampered by economic and policy uncertainty, and in some member states by a high level of public debt. Add to that further uncertainties concerning the geopolitical situation in the Middle East, the refugee crisis, Russia, and the Chinese market, and it is clear that trying to predict the future is going to be difficult.
The construction industry can be thankful, though, that the recovery seen since 2014 has continued. In fact, the 2014 increase in construction output of 1.7% was improved upon in 2015 with a rise of 2.4%. In 2015, FIEC figures showed that EU overall construction output amounted to €1,241 billion. That's €1.24 trillion, which represented 8.5% of GDP. The percentage of GDP taken by construction varied enormously, as always, between countries. For Bulgaria, it was as high as 15.9%, Sweden was 14.5%, and Finland was 14.1%. In comparison, for Cyprus it was 2.9% and 4.5% for both Croatia and Greece. Taking the EU construction output figure and adding Switzerland, Turkey and Norway brings it up to €1.41 trillion. According to the figures from FIEC, this compares to €971 billion in the US and €385 billion in Japan. total construction is definitely still going in the right direction and is predicted to continue to do so. From the high point in 2007, charts show a dramatic slide between 2008 and 2009, a slight recovery in 2011, which was followed by disappointment as there was a further tumble to a low point in 2013. Since then, the figures have been on a satisfying, if unspectacular, rise. House building and non-residential started to grow from 2013, while for civil engineering, the bottom was not reached until 2014.
At the top of the European Construction Output League in 2015 was Germany, with a commanding €297 billion. Next was the UK with €163 billion, then France with €160 billion. The top five was completed by Italy at €129 billion and Spain €101 billion. That traditional top five grouping was not really troubled, with Sweden recording €63 billion, the Netherlands €57 billion and Poland €51 billion. Euroconstruct is a group of research companies which has a network covering Austria, Belgium, the Czech Republic, Denmark, Finland, France, Germany, Hungary, Ireland, Italy, the Netherlands, Norway, Poland, Portugal, the Slovak Republic, Spain, Sweden, Switzerland and the UK. The latest Euroconstruct conference was the 81st and was in Dublin, Ireland. It heard that growth in total construction output for both 2014 and 2015 had been revised downwards from the projections made in December 2015 at its Budapest, Hungary conference, as 2014 saw output increase by 1.1% as opposed to 1.3%, while 2015 saw growth of 1.4% rather than 1.6%. The conference heard that overall construction output in 2016 was expected to improve by 2.6%, although this was said to be below the forecast outlined last December. An unchanged growth forecast of 2.7% was estimated for 2017, followed by a rise of 2.4% in 2018. Euroconstruct said this was an improvement on the forecast of 2% growth, outlined last December. The Central and Eastern European countries were expected to achieve the greatest gains from 2015 onwards. Euroconstruct said factors ranging from improving real household disposable income, low interest rates and the European Commission's investment plan for Europe were expected to contribute to the modest overall average growth in construction investment of 2.6% per annum over the coming year in the Euroconstruct area. It was said that public finance constraints, as well as public and private debt levels, would continue to act as a restriction on public and private investment. Although Euroconstruct said that its market didn't stabilise in 2015, it saw a diverse range of growth rates recorded across the 19 member countries during the year. Strong output growth rates were noted in the Slovak Republic at 18.5%, the Netherlands with 7.8%, and the Czech Republic at 7.1%, while countries such as Austria, France and Switzerland contracted marginally in 2015.
As far as construction machinery sales go, figures from off-highway research confirm that the overall gains experienced in 2014 by the European market for construction equipment had not only been maintained, but consolidated, resulting in a generally stable situation. However, this stability was not experienced in all the Western European markets analysed by off-highway research, as results varied considerably from country to country. Measuring markets by units, Italy saw the largest increase in machine sales in 2015. Of the 15 European countries covered, France suffered the largest reduction, both in terms of percentage and of unit sales. In percentage terms, the largest increase came in two markets, which have experienced major growth, followed by catastrophic declines in sales in the 2008-2009 crash: Ireland and Spain. An 80% increase in demand was seen in Ireland. Spain, despite having the second largest increase in unit sales after Italy, continued to lag behind the 10-year average by as much as 38%. In 2014, the UK became Europe's largest construction equipment market, pushing Germany from the position it has held since 2009. While the UK remained in first place in 2015, its lead was reduced to just 518 units, or 0.4%. Off-highway research found that last year, these two markets alone accounted for over half of all the construction equipment sold in Europe. France, once a market leader, remained in third position, but with the poorest level of sales since 2010. It accounted for just 16% of European equipment sales, compared with 19% the previous year and 21% in 2013. Off-highway research reported that the four dominant markets, that's the UK, Germany, France and Italy, accounted for roughly 75% of the demand in Europe.
There's nothing new in pointing out that European countries are growing or slipping back at markedly different rates. It has always been that way, and geographical, political, and sometimes historic factors will always be relevant at a national level. While the uncertainties certainly exist, there is still evidence that much of the continent's construction industry is in increasingly good shape. Time will tell, but Europe still has a massive, impressive, and largely healthy construction sector. Nothing can be taken for granted, but there are reasons to be cheerful.